Hello and welcome to another episode of the Millennial Investor. Today we have a very special guest with us, Mr. Amit Kumar Gupta, Fund Manager, PMS, Adroit Financial Services. He's going to talk about the market as such and with a special focus on the mid-cap space. So let's all welcome Mr. Gupta. Mr. Gupta, welcome to our show. I must say the morale is very high. The markets are moving slowly moving towards their all-time high. And I was just like listening to some of the commentaries which are saying that maybe by the March end, we have Nifty touching record highs. So what do you feel about the markets at these levels?
Yeah, thanks, Geetu, for having me on your show. So yes, the markets have been up. It's been quite a surprise. Nobody in their right mind would have predicted such a fast rally, even though some signs were there earlier also. But I guess most people have been taken in by the surprise at the pace of the recovery of the markets from the March lows. So the Nifty, excluding financials, are already at a new high, almost new high, just like 5-6% away from the high. And markets have obviously rallied a lot faster than what anyone would have thought. But the global trend, it's just not specific to India. In fact, we are actually underperforming some of the bigger financial markets. But definitely, this is a global trend. So this trend can, in short term, can surprise you because of the liquidity which is floating around in the markets, pumped by RBI and other global central banks also. So that the markets are a little overheated, but market is believe that the impact of the COVID-19 is going to last for probably for a shorter time than what people thought earlier.
Mm-hmm. So 2020 is going to end soon. So we all so much we all feel that the crises are near to getting over now because most of the drug companies are saying they'll get the medicine by January, Feb, or the middle of March. So a few more months to go. So that is what is being celebrated by the markets. If we talk about the PMSs, they have been performing very well. I was just going through a few of the reports which are saying that from the March lows, many of the PMSs have given a very good return of 50 to 60% for their clients. So you also managing funds. So what has been your performance and how has your experience been with dealing with such markets?
Right. So the performance of the fund is about up for about 50% from the bottom. But again, it depends on client to client, where when the client has come, how we have deployed the money, which stocks which we have deployed the money. So relatively well, we are much better placed than what we were at the March lows or the April starting. And the key is that because of COVID-19, we have to make certain changes in the strategy, and those changes have now been implemented. So we are now hoping that the new stocks which we have brought in are going to last for a couple of 2-3 years, whatever is the story in those stocks, and hopefully we can deliver returns for the clients.
Let's talk about mid-caps, Amit. Mid-caps are outperforming the broader the benchmark indices, if we say, and the kind of recovery but that we have seen in mid-caps in last 2 months, in fact, they have been underperforming from last more than 1.5 or 2 years. But now they are coming back into action. So what is pulling them up? I mean, if we look at their Q1 earnings, I mean, some of them have surprised, in fact, but majority of them have not performed. I mean, they might be moving on assumptions that the future is going to be better and the worst is over. So, what do you think? I mean, why are mid caps moving?
So, for to understand that, we probably have to go a little far away in the time before March. And we need to understand that for about almost 2 years, they underperformed the market from January 2018 till about December 2019, January 2020. And then when they just started performing again, when the earnings start coming a little bit in certain sectors, then again, COVID happened and then they fell again. So what has happened is that they were actually underperforming for 2 years. So there was a lot of polarization in the market. So the Nifty was being pulled by 10, 15 stocks only. So that underperformance had to be, matched up at some point of time, because we were seeing signs of green shoot, signs of economy coming back by January this year. Uh, but the critical thing is that when the markets fell in the March, many of the large caps also fell, and they fell even more harder than the small caps and mid caps. In
Right.
fact, in the last week or so of the fall, only the large caps actually fell, and not so much mid caps and small caps. So that was one indication that probably they are bottoming out in that sense. And the most of the FIs and the hedge funds who were invested, they had very polarized view of the. I mean, had a very view which was leading up to polarization in Nifty. So even if when the market started moving up, we were seeing certain stocks like Reliance who was taking the bulk of the returns. In fact,
Right.
it has contributed more than 1,000 points in the Nifty. As compared to that, mid caps and small caps still have still were underperforming and undervalued, and they had still some way to go. If you go by historical valuations, also Nifty mid cap is now available at about 21, 22 PE. This was
Right.
100 at the January 2018 peak. So we have got some time, some distance to cover. So
Okay.
there are growth pockets where investors are willing to invest their money in the mid cap, small cap segment. And since I invest mostly in that segment, so I am finding value in a lot of pockets like pharma, chemicals, and even IT, where there are opportunities to invest. What can be possibly the next leader, next growth leader. Having said that, we also need to understand that this segment has been affected by the corona lockdown, like any other business, and the earnings may come a little late in the cycles.
Okay.
So that will take some time to bounce back. But what is happening in the market is discounting FY21 earnings. It's going to be a washout year in any case for corporates. So market looking at FY22-23 earnings and saying that till that point of time, liquidity is driving most of the stock prices, and we hope that earnings will eventually come back over the next 2 to 3 years
Okay.
from a low base. But that's what we are. So liquidity is one major factor in what is pushing these stock prices to phenomenal levels, to overheated levels. But till the liquidity is there, we might see this rally extending a little bit more.
Still, you specialize in mid caps and small caps, as you said. So, which are the sectors that you see would be? You spoke about the growth. You are looking at stocks which might be a growth story to begin with, and will give yield a better return in say next 2 to 3 years. So, any specific sector that you think has not performed till now, but has scope of performing better in times to come?
Okay. So, the sector is one thing, but first you need to understand how you want to construct your portfolio. What is your portfolio approach, and what are the kind of stocks you are looking to buy? So, there are two factors basically where we are looking at when we are selecting any stock. So, there are one set of stocks which are more compounding in nature. I call them as core stocks, and which generate very high return on equity, and therefore they deserve to trade at a significantly higher valuation than the market. But in the environment also, if you look at some of the stocks like Asian Paints or Page Industries or 3M India or Honeywell, these kind of stocks are also perceived to be very high valuation stocks,
Right.
but they are still
Right.
well in this sort of environment also, and they're least impacted in terms of earnings. They are solid franchisee. They're compounding their earnings still over. They have compounded their earnings over a period of time, and they're least impacted in terms of earnings, and therefore there is a fair degree of comfort that despite COVID, earnings will still hold up. And in terms of return ratios profile, they can continue to deliver on the high ROEs, which will be significantly higher than the market average. So,
Okay.
valuation multiples for such kind of stocks will probably sustain. So that is one category where we are almost invested like 30% of our portfolio in the core stocks. The other stocks, a set of stocks which we are evaluating are like which are really beaten down in the nature. Stocks where valuations have become very attractive, extremely attractive. They're trading
Mhm.
like single digit or early double digit kind of a PE. So here it will take some time for the fundamentals to catch up. There is hope that improvement with the economic growth starting to pick up. We might see some of these stocks which are trading at valuations which is significantly less than their 10-year average, and they
Mhm.
start as a turnaround stories. So that takes about 30%, where we are expecting that a multiple re-rating can happen in the
Okay.
market. These are the kind of set of stocks which we are playing through in this kind of market. Uh, so from a like portfolio perspective, we are running a fairly balanced portfolio. We have got IT, chemicals, and pharma. Pharma is the dominant player. So we have
Mhm.
about 40% weightage in pharma, healthcare, and insurance space. And
Okay.
after that, we have about 20% in devoted to chemicals, and rest is divided between IT and a fair bit of non-lending financials.
Have the FIIs finally started digging into mid caps also? I mean, have their participation in mid caps increased?
Foreign investors have actually remained neutral on India. They haven't been very gung ho on the markets, even though that may give you an impression by the prices. But a very large part of the flow that we have seen in the recent times, last couple of months, that has been mostly towards the primary issuances. So you have got these very lot of block deals which are happening because a lot of companies are raising money from the market, especially the financials, the lending financials. A lot of banks have raised money, so that flow of the FI number is a little higher. But
Mhm.
the kind of investors which we are talking, they're waiting to see how India cope up with the corona pandemic. We are still not fully open. We are waiting for certain states to open, certain segments of the economy to open.
Mhm.
Uh, so those investors are waiting to see, what are the data points which will come and how the companies will recover. So they are also shuffling portfolios among the various sectors to bring in money. But as you also know that the most of the market move that has come from either the retail money or some of it have from the HNI money or the DIs, LIC, basically.
Mhm.
Mutual funds have seen actually outflows in the last couple of months. So I
Yes.
would say that your foreign investors are neutral on India and they're waiting for either market to go down or they're waiting for the like fresh data to come in and see how we are going to move in the next couple of years.
Amit, we have lately seen that there are some of the stocks which are performing well. I mean, they have given a return of more than 1,000% in just 2 months' time. And these are penny stocks. Most of the retail rush which we see in the markets get caught in these penny stocks, which basically do nothing. Their business is nothing. But these stocks are moving higher and higher. And retail investor, because they have a little money in their hands to invest in stock market, they get trapped into these small value stocks. So what should one keep in mind before investing in these stocks, and should these stocks be really invested in at first instance?
Right. So, I want to use a quote of Vidya Balan, which says entertainment, entertainment, and entertainment. There is a certain section which always believes in entertainment in the market and not really in the money making business.
Mhm.
What I personally feel is that at a very basic level, we have still a long way to go as far as the investor education is concerned, and
Right.
we have seen this happening every cycle. This happened in 2017 also when a lot of penny stocks actually went up 1000 2000%. That is happening also because the liquidity is also available. Obviously, that has got to do with what has happened with the retail money in the past 3 4 months. And that is also because, especially because of the coronavirus. So we have got these Robinhood traders who are sitting at home. They are either jobless or they have some spare time. They've got internet access. They have got advisory access now over the internet, and they want to invest into a stock market, so they want to trade into the market. So that is pushing a lot of these penny stocks up. Also, what has happened is that a lot of corporates, their working capital is not getting utilized, so they have also
Okay.
come into markets and trading to just earn extra income, because
Okay.
ultimately the business is not working. There are certain segments which are just not open. So so a lot of these kind of people are pushing these stocks, but usually when the
The
down cycle,
correction.
these, these stocks do not recover. So we don't want to bring any kind of those kind of stocks. We want to educate our clients also that stick with stable businesses, the compounding franchises, and don't look for too much of entertainment in the stock market.
So actually, what is performing nowadays is just equity markets. It's globally the trend is the same. I mean, your bullions saw a very good move, your gold, silver saw a very good move, and your equity market saw a very good move. The rest of the assets are really dead. I mean, there's no business in real estate happening. So money
Hmm.
is chasing stock markets. So when the money is chasing specific number shares or companies, we keep in mind, I mean, a aware investor will always keep in mind that I have to invest in a business or buy shares of a company which has been doing well. Maybe it has been hit by COVID, but its business model is good and it's going to perform in the future. But it so happens with this retail rush, with people who do not know ABCD about stock markets, they get caught. And when get caught, they make losses and move out and say that stock market is not a place to make money because they are here to make quick bucks. They want to make quick bucks and move out. but वो आते तो है अंदर, वो जाने के
Hmm.
समय वो खाली हाथ चले जाते हैं. तो ये आमतौर पर देखा गया है. ऐसे में आप सजेस्ट करते हैं इन छोटे निवेशकों को जिनके पास पोर्टफोलियो बनाने के लिए पैसे बहुत कम है, शुड दे गो इनटू द स्टॉक मार्केट डायरेक्टली और शुड दे गो थ्रू म्यूचुअल फंड? इट्स अ बेटर ऑप्शन फॉर देम टू गो थ्रू म्यूचुअल फंड और you know with some broker they can open an account and that broker can manage the account for him, something like
Hmm.
this,
Hmm.
made for them so that they make money in the markets.
Right. So brokers can not directly manage money, so they need to actually come through a PMS. Brokers can advise their clients. See
But
what
PMS में तो Amit,
uh,
the problem is that a minimum amount is to be given, right? Or you can
right.
start.
It's 50 lakh. Yes.
So that is where we get stuck.
Yeah, so for them, the mutual funds are the best play, because you can invest at regular times. You can do an SIP, and whenever you feel that market has gone down too much, with the help of an advisor, you can even invest in lump sum. And also, the most important thing is to develop a habit of investing over the period of time. See, volatility come. Nobody could have predicted that March will get a 40% fall, and nobody could have predicted that we'll get a 50% rally from there.
True.
And the small cap rally has been almost 75% now.
Right.
So nobody could have predicted. But if you were invested and you're not bothered too much about the volatility, then you play all the cycle, and you'll invest all through that cycle. So for small investors who have like 5, 10, 15 lakhs of portfolio, it is much better to go through a mutual fund. Or another way is to find an advisor who can actually advise you at every point of time why they're buying a particular stock, and why, make you understand what is the reason, what is the cycle in that stock, how the earnings will grow, what are the products, everything. You have a holding hand. So in my 2 decades of experience, what happens is, in the first cycle, when people, investors come into the market,
Hmm.
then in the first cycle they always make loss. Okay. Second, in the second cycle, they take help of an advisor. Okay, and with the help of an advisor, they still do. They don't listen completely to the advisor, and then they do something on their own also. So
Right.
in sometimes make profit, sometimes make loss. But in the third cycle, they are able to decide clearly whether I cannot handle this because I don't have the bandwidth or I don't have the financial knowledge to implement this. So I'll go with a either go through a PMS or a AIF or a mutual fund, or I am capable enough to understand this market. I've seen two cycles now. In one, I have made a loss. In one, I have made a small profit. So now let me do it full time on my own. So my
Mhm.
sense is that people, it's also a learning curve for a lot of retail investors. And when you have gone through a couple of cycles, then you are able better in a better condition to understand whether you want to go through a PMS or whether you can do it on your own. And nothing like do it on your own. It's the best. You save cost also on that, but you need to be very sure because it's not a entertainment business. It's ultimately a money making, serious money making business.
Yeah.
So that is important. Yes.
Amit, India for now has been thriving on its internal demand, but demand is absent from the market from last more than a year now, and COVID has added to it. Auto sector, if we talk about, now we're talking about demand, which is going to come back by festive season, which is just 2 months away from now. Do you really expect that kind of a demand to really come back?
The demand, see, currently what has happened is because markets, all most of the markets were closed for about 2 3 months. So there is a lot of pent up demand which is coming, which we are seeing in tractors also, we are seeing in autos also. Obviously, the FMCG demand never went down because people were delivering this e-commerce and apps. Your apps were delivering at home also, so
Online.
that went down. But the other discretionary demand definitely went down. So as you have seen the commentary of most of the corporates, so they are saying that okay, June is better, July is better than June, August is
June.
better than July. So, in terms of overall growth, we had seen that in the months of June and July, there was a sharp pickup of the lows from the March and April. So, all the high frequency indicators have also moved up quite well. And towards like the end of July, early August, we have seen that some kind of a plateau is happening on those high frequency indicator in terms of economic improvement. So now today the market is saying that let's build up for the festive season. We'll see kind of demand push incentives comes from the government side. As per the new latest media report, they are considering a cut on the GST on autos
Two-wheeler.
also.
Yeah.
And there are other media reports also which are saying that they want to boost demand.
Mhm.
Uh, if by the festive season we get to a sort of a normalized growth rate, then that will be at least the market can hold up by then. Because we've already been like a 70 80% of the pre-COVID levels in terms of growth, and
Mhm.
hope by the festive season we'll get to that level, 100% level. But if they delay in getting back to a normalized run rate, then there could be a lot of disappointment from a market perspective. So I personally think that it will be difficult to get a 5% growth next year also.
Mhm.
Next year mid year, so like next year August, it will be difficult more than 5% growth. The risk could come a little bit from the financial side because the lending is getting very scared, and
Mhm.
the lending is not that freely available. So some push has to come from the government side to boost the demand immediately. We cannot wait for 3 to 6 months to pass by and then take an action, because
Mhm.
remember, we were very. I mean, our growth levels were very low even before pre-COVID. We
Very
were not
true.
rocketing in terms of growth.
Mhm.
So my sense is that if some measures come in the next couple of months, whether it's in the form of tax cuts or whether in terms of stimulus measures, then we can run a little faster as
Do you,
compared to what is happening currently.
do you expect it to come? I mean, direct benefit uh, to the consumers from the government side? I mean, there have been change in shift in policies. There have been announcements with respect to different sectors, but the direct impact that must should be felt is not there. So do you expect government to announce a few more steps to boost the consumer confidence and increase the spending in the market? I mean, reports are there. Do you expect?
Yes, I expect them to do something, but what exactly? Because the policy making has been a little ad hoc, in the sense that sometimes the policy making happens and then they have to revert back to it because there is a lot of criticism onto it. So that has been the trend if you look at the past couple of years. So, for example, the recent report which says that they are going to cut GST on two wheelers.
Yes,
The they have given is that it's not a thin good or a luxury good, so that's why we want to reduce it. But if you two issues in it, one is that the commercial vehicles are at 28%, and they are also not a thin good or a luxury good. So
right,
them, or the cement which they are carrying, a commercial vehicle is carrying, that is also not a sin good or a luxury good, but that
right,
is still 28%.
right.
Secondly, you cannot have a again have a inverted duty structure where the auto ancillaries are at 28% and the two wheelers are at 18%. So
True.
if you want to do a GST cut, then you need to do it all through the auto
Across
chain
the board. Yes.
across the board, all through the so the paint, the tires, the chemicals which are used in it, the auto ancillaries which are used, everybody has to be cut to 18% GST. And it's not like permanently. If they can do it like for let's say 6 months,
Hmm.
October to 31st March 2021. Even for 6 months, if you do it, then a lot of demand will automatically come up. So they need to probably think a little out of the box and see how we can, do that. Do what we can do to stimulate demand. In that sense.
Yeah. One sector which was neglected till now was agriculture. Nobody spoke about agriculture in last so many years, and now agriculture is back because of the movement of labor from urban areas to rural areas. They got stuck there, and now they are working on their fields. And then you have Atmanirbhar Bharat, where agriculture will play a very important role. Food processing is being now focused in. Now, this sector, which has been contributing to GDP, but the contribution has been falling from last so many years, is now again in focus. So, any of the companies that you find in this sector should be good for investment in long term.
So this has been true that there are still a lot of reforms which need to be done for agriculture to boost the productivity, and obviously the shift has happened from urban to rural because of that. So, but there have been schemes. We have seen the latest economic data, the Manrega data which has come last week, that has shown that people are actually taking up those jobs and contributing to the rural economy. So my sense is that you should get into those kind of stocks where there is a vision of we can predict at least 2 3 years of earnings. So something like a tractors business that is growing very well because there is easy finance which is available now. Very liquidity is a lot. There is a lot of finance institutions now in terms of microfinance institutions or NBFCs who are ready to lend at that level, and they are well franchisees in that. So tractors is one where we are very positive, and we think that that one segment where the growth can come year on year for next 2 3 years. Apart from that, we have couple of agrochemical stocks also in the our, and there is a lot of push from the government side also. Lot of incentives are there. A lot of
Imports have been banned from China,
yeah,
chemical
import
imports.
duties have been banned from China, so that is also helping in the increase in the demand of these chemicals, agrochemicals. Yes.
Last question about the financials. If we talk about the banking system now, a lot many changes. The credit growth has been picking up, but marginally. Uh, Risk aversion has increased because they now think that moratorium is coming to an end on 31st of August. What happens after that is to be seen. But last few weeks, we have seen a very good rally in all the stocks, mainly the frontline PSU banks and the private sector banks too. So banking space, do you like it? And which of the banking stocks would you bet on?
So what has happened is that obviously the moratorium is now coming to an end on 31st August. So RBI has now come up with the new restructuring norms. They have constituted a committee with KV Kamath, and they are coming up with new norms. So the important thing is how we are seeing the payment behavior after the moratorium gets over. So that will actually decide the extent of the NPA provisioning which banks need to make. So my sense is that all the capital raising which has also happened, that is because most of the banks actually anticipate a lot of NPAs to come from it. So most of these
Okay.
entities, they've either raised capital or in the process of raising capitals. And if you
Yes.
hear the commentary of RBI governor this morning also. So there he is very explicitly told all institutions that go ahead and raise capital in this high liquidity environment, because they want RBI also want the financial institutions to build the buffer for the higher credit costs whenever it comes, and you will get a lot of NPA loans because of the business cycles continue to be in the stress, and I think it will take about 6 to 9 months to for that recovery to happen. So as of now, we have reduced our financials weightage, and we have shifted that financial weightage to non-lending financials, which are your AMCs, brokerages, insurance, both life and general insurance. And we have reduced our financial exposure in the portfolio. We have only top 2 3 names: HDFC, Kotak Bank, ICICI Bank only, and rest of them we have shifted that weight to non-lending financials. So, so
Any bets on infra, Amit?
infra, so there are a couple of names we are not yet invested into them because we want to, do some more groundwork on them. There are a couple of them are on our radar, like PNC Infra and KNR Constructions, who have done very well in past cycles. Whenever the infra down cycle has come, they've been able to hold, and they have been able to, maintain their revenues and the sales and the margins. But I think cement can be a good play going forward, because we are already seeing a lot of consolidation happening in the local area, the regional areas. So the is getting better in that sense. So in that space, we like couple of mid caps. We like Birla Corp, we like Ramco Siemens. So these they are the couple of stocks where we are invested, and these may be regional players, but they have the capacity to become big. And now what we are also seeing is that whenever the price hike happens, so everybody raise the price. They don't wait for others to adjust prices. So the price hikes also happens there. So in the whole year, there is always a period of about 3 4 months of monsoon when they don't perform. But during the, if the infra cycle comes up, and if the government gives the projects as they have been anticipating, then I think cement will do well in the next cycle.
For the mid cap space, if you talk about, there are so many mid cap shares to invest in, but the money, gets you feel short of money to really invest in them. So if you have to give an advice to retail investor and he has a very small amount of money in hand, where should he invest in, and what should he keep in mind before investing?
So, keeping the expectation levels is very critical at this point of time, because when you see stocks moving up 10 20% in a day, your expectations skyrockets. And for anyone who is new to the investor, who hasn't seen the history of how the equity markets behave, they may have very unrealistic kind of expectations from the equity markets. So firstly, understand what kind of expectations you have, and secondly, it's better to bet if you're even if you're doing it on your own, trading on your own. It is better to have an advisor, especially if it's your first cycle and you're very new to the markets. Then it's better to have an advisor to tell you at least when to exit or what not to stop. So investing is a lot more what not to buy rather than what to buy.
What to buy,
So,
right?
advisor can help you in that at least what not to buy. So even if you are stuck in a stock, you bought a stock, let's say at top of the cycle, or you've got stuck in a cyclical stock, at least that stock has an ability to come back into the next cycle. and do not become a penny stock where your capital loss is permanent.
Thank you, Amit, for speaking to us. It was a pleasure talking to you.
Thank you. It was a pleasure to be here.
Thank you so much.